All right, market heroes, we're back. A little back of the books right now. These terms that you see right here are terms that are used to describe options at different levels in the option chain, right? Whether they're up, down, puts, calls, etc., depending on what the price of the underlying stock or ETF is, whatever the case, right? So we have ITM, which stands for in the money, right? And in the money is a way to describe an option. ATM, at the money, is a way to describe an option. OTM is out of the money. Intrinsic is intrinsic value, which is a way to describe the price of an option. And extrinsic is extrinsic value, which is also another way of describing the value of an option, right? So these terms are important to know because we're going to be talking about them for forever, right? I hope that you are a market hero for the rest of your life. I hope you make hundreds of thousands of dollars, millions of dollars working with me almost every single day to become a market hero and to be able to provide financially for you and your family for the rest of your life. But as long as you are doing that, you will hear these terms and you need to understand exactly what they are. So I'm not going to give you like the dictionary definition for these terms. That's not really helpful. I'm going to give you what they mean to me and the way best related that my students and my fellow market heroes understand, right? So very, very important to understand what these are. And again, they're just different ways to describe options depending on where they are in an option chain. Nothing crazy. So ITM. In the money, right? In the money represents an option being in the money. Duh, right? An in the money call is where the price of the stock is above the strike price or the delta is greater than 50, right? So let's take that one by one. The first thing is an in the money call is where the price of stock is above the strike price, right? So right now, the price of SPY is 246.5, which means any strike below that is in the money. Right? And the way to see that is the delta is greater than 50. So every strike from 246 down, right, that has a delta greater than 50 is known as in the money. At the same time on the put side, right? An in the money put is where the price of the stock is below the strike price, right? So again, anything that has a delta greater than 50 on the put side, right? So right now, the price of SPY is 246.50. Right? And again, an in the money put is where the price of the stock is below the strike price. So if we find all the strike prices that are above that, those are the in the money puts, right? So anything from 247 up, right? If we own a call, we want the call to expire in the money. Why is that? Well, if we own a call, right? If we own a call, that means that we want the value of the call to be worth something, right, at the end of the day. And it's only worth something if it expires in the money. Same thing if we own a put. We want the value of that put to be worth something, right? And it's only worth something if it expires in the money. Out of the money, right, represents an option being out of the money. Yes, we know this. An out of the money call is where the price of the stock is below the strike price, right? Or the delta is less than 50. Right, so let's take a look at that, right? Remember, an out of the money call is where the price of the stock is below the strike price, right? So right now, we have a 246.5 stock, meaning if the stock is below these strike prices or has a delta lower than 50, that is an out of the money. That is an out of the money call. So we see everything from the 247 strike up, whose deltas are less than 50, being out of the money. Same thing on the put side, right? Anything with the delta 50 or below, right? Anything with the delta 50 or below. So we have the price of the stock above our put, right? That would be out of the money, right? That's an example of out of the money. Now, if we sell a call, we want the call to expire out of the money, right? So if a call expires out of the money, it's worth 0. If we sell an option, we want it to go to 0. And the same thing happens for a put, right? We want the put to expire out of the money as well, right? If we sell a put, we want the put to go to 0, right? So the only way we make money for the most part selling options is if they expire out of the money. And then we have at the money. So at the money represents the options whose strike prices are closest to the price of the underlying stock. And the at the money call and put typically have deltas closest to 50, right? So right now the price of SPY is 246.58, which means that the closest strike price to that, the at the money strike, would be the 247 strike, right? And what's interesting about the 247 strike is that theta decay is greatest at those strikes, right? Let's take a look and see what that looks like here. So I'm going to go to customize. I'm going to get rid of this, right? And I'm going to go to theta. Right, as you guys can see, theta decay is highest at the money strikes, right? Totally makes sense, right? Makes sense. So that's why things like straddles, strangles that are close to the money, you know, heavy iron condors, etc., etc. That's why they are so profitable, because we are selling those options that are closest to the money. We're selling options where the value of those options is getting decreased more rapidly than all other strike prices, right? So that is at the money, right? Nothing crazy there. Then we have something called intrinsic value. So intrinsic value represents the real value of an in-the-money option, right? So again, what is an in-the-money option? It's an option with a delta greater than 50, right? So again, we see over here on the call side, it's the 246 strike down, and on the put side, it's a 247 strike up, right? Those are their in-the-money options, right? The intrinsic value, the value of those options, right? And the interesting part about that is those values don't get decreased from the price of the option, right? So the price of the option gets increased by something called theta. The intrinsic value does not ever get removed from the price of the option. Only extrinsic value does, right? So extrinsic value represents the external value of an option that can be seen by an options premium, right? So extrinsic value does get removed from the value of the option via theta, and the extrinsic value of every option is 0 at the end of the day. So there's a couple things. Let's talk about an out of the money option first. Let's talk about the 250 call, right? The 250 call currently has about $1.02 worth of extrinsic value, right? That is kind of like the fairy dust value that if this option expires out of the money will go to 0, right? And then on the other side, if we're looking at an in the money option, for example, let's say this 250 put, its extrinsic value is its out of the money value, right? It's in the money, but to find the 250 puts out of the money value, we look at the 250 call. And again, the extrinsic value of the 250 call is the value of the 250 put, which again is about 102. So if you are let's say if you have sold a 250 put, right now the price is about 521, let's call it, right? It's about 521 right now. And you want to know if the price of SPY doesn't move at all, what it's going to end up, what the value is going to end up being, because right now it's about 521. Well, you take it and you subtract the actual extrinsic value of that option, which is about 102. All right, so it's about $4.19 is how this option is going to expire if the price remains at 246.58. So that's what extrinsic value means. Again, guys, intrinsic value at the money, extrinsic value out of the money, all that stuff is a big deal because we just talk about it a lot. Depending on if an option is in the money, at the money, out of the money, that will dictate exactly what type of strategy we'll be using. That will dictate what type of strategy we'll be using to improve on our positions, etc., etc. So very, very important stuff. I'll see you on the next video.